Good afternoon, and thank you for joining us for today's roundtable. The topic this afternoon is corporate deal-making, increasing shareholder value through trade sales, spin-offs, and carve-outs. I'm Ben Collins with Intralinks, and I will be moderating today's discussion. There are a number of key points to take into account when determining how to evaluate and structure these transactions, including valuation, communication, and regulatory issues, which will be the subject of our discussion here today. Joining us are Brian Buchert, Director of Corporate Strategy and M&A at Church & Dwight, Kenneth Myers, VP of M&A at Siemens Corporation, and Roger Maranzoli, Senior Managing Director of M&A and Corporate Development at TIAA Carve Financial Services. So we've got a lot to cover today. So let's get started. What I'd like to do, start with you, Roger, and just think about how we define the terms that I just rattled off. I feel like we all use those a bit loosely. What is a carve-out? What is a trade sale? What is a spin-off? What is a divestiture? What do those mean to us? How do we think about those and really use that as the launching pad for the discussion here?
Sure. I think that the definitions depend on where you actually sit in terms of the corporate development process. I think from a strategic perspective, people have come to use these terms relatively interchangeably, and a spin-off, a spin-out, or a carve-out are really talking about moving non-core assets out from under the ownership of the company. So basically a sale of one form or another. When you think about it technically, and I used to unfortunately be an investment banker, I had to define very precisely what these terms mean. So a carve-out really indicated some type of flotation, or perhaps a put to a management group that would have some percentage, usually 20% or less, to incent management or to create a value for the actual subsidiary. When you think about a spin-off, you're thinking about a tax-free give back of shares of a new entity to the same shareholders. And then we can get into split-offs and other technical terms, but there's really two angles to think about it. And maybe we can have our viewership ask questions around those two angles.
Yeah, Ken, was curious if it sounds like there might be almost some generational misconceptions around how we define these terms. And we were talking about that earlier.
Yes, I think so. I think that there are some traditional, perhaps formally used notions about what these terms mean, and I agree with Roger. I think traditionally the spin-off has meant that the tax-free distribution of the shares of a previously owned set of internal operations to the current shareholder base. So you create a new company that's publicly traded, whereas a carve-out I think meant more of a corporation deciding that there are certain assets or operations that don't fit anymore, so those are separated from the core operations and prepared for a trade sale. I think now spin-off is used much more generally and generically to refer to any sale, and I think it's kind of lost its original, more technical meaning.
Yeah, Brian, the spin-off, it seems like, again, one of those terms that gets a bit ubiquitous. It's thrown around a lot. Mm-hmm. What does it mean to you? Have you seen it misused, and how do you think about it?
Yeah, we look at a spin-off less so from our perspective as a company, but more from buying and looking at third parties. And to us, a spin-off is basically you've decided that a business isn't core to you and you want to jettison it from your portfolio. And how you structure it, it depends on the situation, but mostly it's some form of a sale, or at least a for sale sign outside that says, please come and make me an offer, because it's no longer and you want a backup option perhaps to take it public or to spin off to your shareholders. But it comes back to the fundamental decision that's been made that this is a non-core asset that you're looking to get out of your portfolio. So, we look at it a lot from carve-outs, spin-offs, all these things. It's really just evaluating whether it's an interesting asset for us.
Yeah, interesting. So now that we sort of have our terms straight, what I'd like to do is shift gears and talk about why and when we think about these potential options within the lens of strategic transactions and alternatives. And so, Ken, maybe you can get us started. What are some of the motivating factors behind your thinking with regards to these?
Well, selling something is frequently not an easy decision, sometimes a very painful decision. But we try to apply a fairly strict set of criteria. Perhaps something doesn't fit our financial objectives anymore. We're very focused on capital efficiency. If we have something in the portfolio that's not generating an attractive return on capital anymore, we might consider divesting it. Or if there's something in our portfolio where we're just simply not the best owner, it's not generating synergies within the larger portfolio of our businesses, or it's creating revenue or earnings volatility that we otherwise want to avoid, we might consider divesting something and trying to make it separate or independent, or maybe it fits better with another owner. We'll try a direct trade sale. But there's a number of criteria. So maybe something doesn't fit with our verticals anymore. Our customer base at Siemens is primarily institutional and corporate. So if there's something that isn't aligned with those customers, we might consider divesting it.
Brian, I know you've got some experience in just at least thinking about these types of transaction types. So wanted to get your thoughts and see, what are those primary drivers as you're sitting in that cockpit?
So for Church & Dwight, we're a predominantly consumer product, pretty straightforward business where we own 80 brands globally. 10 of our brands provide 80% of our sales and profit. So when we look at divestitures, it's usually in the context of an underperforming brand or operational complexity is actually arguably more important, quite honestly. And so the third part that we do is, we look at divestitures usually under the umbrella of a larger acquisition where you can divest something within the window of accretion from the deal so that we don't have to get hit with any sort of dilution in the near term. We trade at a healthy multiple, and so it's usually not economically viable to sell something. And so, but we will look at our portfolio when we acquire something large, and we've done that in the past. We sold 3 businesses, and to be honest, our part of the dialogue is sitting around the table and actually asking the question, what operationally do you spend an inordinate amount of time on as a company vis-a-vis the benefit it's providing to the corporation? So a brand that provides 5% of the sales, yet your team is spending 25% of their time on it, is not a very good use of your activity. And we've had that exact conversation, and we've sold brands that have tried to streamline organization, made things simpler to go to market.
Can I, so when you're looking at an acquisition, Brian, you will see things that are going to come with that acquisition that you already know at the outset, either in due diligence or at the time of making a proposal, they're not going to fit. And are you able then to model into your acquisition a potential divestiture? In other words, you're placing a divestiture value on something you don't own yet, and you're already addressing the dependencies and the carve-out issues.
It is exactly what we do, and we've done it. I'll give you the live example is a few years ago we bought a brand called Oragel. Anyone has kids or ever had a toothache, you've probably used it. And we knew going in it came with 5 other smaller brands that we affectionately called the 5 plagues. It fixed things like boils and earaches and very small brands. We went into it knowing we didn't want to own those small brands, and we actually we wanted the 80% and not the other 20%. So we structured the deal and we diligenced it and we gathered information so that we could quickly basically package those brands and sell them off. And so we went in with our eyes wide open. In our industry, we love buying pure brands, but sometimes it comes with things that you don't want. And it's great if you can get 75-80% of what you want and can sell off the other 20-25%. You can structure a deal that makes sense, and we were very successful with that for both sides. Buyer was happy too.
Roger, I know in your current role you're not entirely focused on divesting assets or any of the carve-outs or alternatives that were spelled out earlier, but in some prior roles, that has been something that you've helped facilitate. And so from sort of a macro level, how do you think about that why and when and the motivations?
Sure, and I think we've covered pretty well the various strategic reasons why we would look at a spin-off or a carve-out or just a regular sale. I think we can also tie it back from the Wall Street perspective, just thinking about it from a valuation perspective. So if you think about a company that has multiple lines of business, and especially activists will look at this in particular, they will simply ask, is the sum of the parts really being valued correctly? And if it's not, both management, the board, advisors Or our shareholders could say, well, if you liberate value, if you unlock value, and you spin off something back to shareholders in a tax-free spin-off, you will create more value. What's interesting is in 2014, the evidence has basically shown that parents have actually been demonstrating, on average, a small premium for doing that spin-off. Now, I saw somewhere that there were about 75 bona fide spin-offs that were actually done in 2014. About half of them were value creative, and on average, about 8% premium accrued to the shareholders in doing that. So there are horror stories about this not actually working the way it should. The carve-out, in a similar way, is a great way to establish a valuation benchmark. If you have an entity that actually has an underperforming stock price at the holding company, but there's a really valuable asset, instead of divesting it completely in a spin-off, you could float a piece of it, 10, 15, 20%, put a market value on it, and now when you do the sum of the parts, now hopefully the parent company stock price gets a lift. So that is another angle of looking at it. Strategically, as corporate development people, we think about it that first and foremost, I think, but valuation plays a huge part in it as well.
Great. Who is involved in these discussions, Brian? I mean, is this getting consensus can be tricky in any of these types of alternatives, and was curious. This isn't you in a room deciding go or no go. This involves a pretty broad universe of participants at the board level, at the executive level, at the business unit level. How do you get that consensus?
Oh, well, it's actually just me deciding. Sorry.
All right,
No,
I take
I'm
it
just
all
kidding.
back. We'll move on.
No, we at our company, we're very open with our management team, having discussions about this. Our CEO, COO, myself will have initial conversations. We'll bring in the senior management team and have an open dialogue about things. And at Church & Dwight, we're very open with our board, and the management team sits in with the board and is fully engaged in conversation. There's not secret meetings about this, and everyone is giving their opinions. For very small divestitures, it's a little different. There's less scrutiny involved, and it can be more done at an operating level. The board will be fully informed, but it's less of a controversial decision. But in general, we review our portfolio, and there's usually general agreement, and everyone understands reasons why and why not. A lot of it for us, again, is a valuation issue. You have to look at it as, is this business really hurting you? Is it going to change your algorithm? So we look at it like we have an algorithm. We have a very distinct economic goals we want to have every year. And if something's really harming us from achieving that, then you can change your algorithm and actually potentially create value and get a valuation bump. For us, in general, people value us on actually acquiring and finding things to buy versus divesting. So I certainly spend the vast majority of my time looking to buy.
So Ken or Roger, wasn't sure if you've had some. I know Ken, you were laughing as I was addressing that question. If you have any particular stories around trying to gain that all the votes that you need in the room to push something forward.
Well, these decisions are made by our managing board. Siemens AG, the parent company, is a German company, so the governance is different than most typical U.S. companies. We have a managing board and a supervisory board on top of that, and our managing board is really responsible for making significant decisions about divesting or acquiring or spinning off or carving out. So if we're going to spin something off like we did with Osram, our lighting business a few years ago, or if we're going to divest something like we did with our audiology business a few years ago, that's a decision that's ultimately made at the managing board level. Division management plays a role in terms of providing information and providing some strategic direction and a strategic plan. And of course, there are valuation and financial issues that come into the analysis. We want to make sure that any company that leaves the Siemens portfolio is going to be able to be sustainable. It's going to stand on its own. It's going to either attract capital or accrue earnings, and eventually, if not immediately, become and be cash flow positive and self-sustaining, whether it's in the hands of a strategic buyer or a private equity buyer, or if it's an independent company that's trading on the exchange. So it's a variety of factors, but the decision making, I'd say, really channels upwards to our managing board.
Roger, I wasn't sure if you had anything that you wanted to add
There
on
were
top
some,
of that.
yeah, I agree. I think what Ken described, I've experienced both as an advisor to a large number of companies as well as being a principal myself. I think that the other factors that are maybe influencers as opposed to deciders do include outside stakeholders, like we talked about before. Again, shareholders that may bring ideas to a publicly traded corporation. Hey, why don't you try to create more value by doing a carve out, spin something off? We've seen that in a number of the activist stories that are playing out in 2014 and years before. I think another factor that really does influence that decision, though, are also regulators. Because whether it is part of a transaction or there are other antitrust issues that have been developed over time, it's obviously much more common with the transaction, you may find yourself in a situation where the regulators will not give you a choice, that you actually have to divest in one way, shape, or form. It's obviously not in the US only, it's all over the world. So we've seen that as well.
Interesting. I think we're going to touch back on the antitrust topic here in a little bit, but I think you broached a good one there, Roger. One of the things that I wanted to discuss quickly is just in terms of how you value or think about valuing some of these assets that you might be looking to sell. Particularly, Brian, maybe if you could get us started, where IP or where human capital or brand is really the value driver for that sale and needs to be considered. And so, given your industry, thought you might have some perspectives on that.
Yeah, I mean, for us, when we look to divest, it's usually a brand. It's usually something that's hopefully well known. I'll give you an example, live example. We sold a brand called Brillo that probably most everyone has heard of. So that one was a lot of brand equity, history, knowledge, understanding. The business itself wasn't incredibly attractive. And that was a case where, to be honest, one of our main reasons to sell the business was it had a plant attached to it that was very specific to the product and had a union force, and we felt it would be good to divest ourselves of a sort of complicated asset in general. So when we look at IP and human capital, generally we don't buy or sell things for human capital. We're actually looking to buy or sell brands effectively to fit into our system. From an IP perspective, sometimes it's important, sometimes it's not. Usually in branded consumer IP, it's not always mission critical, but the brand's the key. It's the trademark, it's the history, it's the advertising behind it. And so that's where we value it. When we're looking to sell, it's, honestly, the bigger issue is finding a buyer universe that would appreciate the asset, especially for smaller assets, and sort of carving out a business that would make sense for that buyer, whether it's private equity or strategic. We'd always prefer to sell to strategic. Sorry to everyone, PE folks out there, but it's a lot easier to sell to a strategic, quite honestly. But we will go both ways. However, in general, we have sold to strategics, and it's. We'd like everything to work out. We want to be clean and clear of it after a deal is done as quickly as possible. The cleaner and the quicker somebody can extract it from us and to not have an ongoing transition services agreement for a long period of time, we would find more attractive in a process, much more attractive.
And Ken, not sure, Roger, if this would apply necessarily to some of the deals that you've evaluated, but Ken, I mean, it seems like IP brand would certainly come into consideration as you're evaluating your portfolio.
Yeah, well, we don't have quite the multiplicity of brands that Brian does, but the Siemens brand has a lot of value and a tremendous amount of global brand recognition. And when we carve something out and we try to sell, whether it's to a strategic or to a PE buyer, that buyer often wants use of the Siemens brand for some period of time after the deal closes and after the asset leaves our portfolio. And we have accommodated that in a number of ways. I mean, usually it involves a license agreement for some period of time, permission to use for some period of time, while the asset undergoes a transformation in the hands of the buyer. It's particularly important for private equity buyers who are relying on running a business on a standalone basis and continuing with the existing customer base while they do the private equity alchemy that makes an asset so much more valuable when they exit in a few years. But we're usually able to accommodate. And in terms of valuation of intangibles like brand or IP, there should be a way of capturing the value and quantifying the value of those assets and putting it into a business plan. If it's brand, maybe it's pricing power, or maybe it's name recognition, maybe it's the ability to comparatively have a lower marketing expense than somebody else who's trying to build brand recognition. If it's IP in the form of patents or know-how, that might give you a technological advantage that enables you to either, again, price more aggressively or perhaps reduce your own running R&D expense versus a competitor. You try to monetize and quantify these things in your business plan so that ultimately you can put it in a model, a DCF model, and figure out whether those intangibles really give you an advantage versus the competition, and that's going to drive your valuation concept when you're selling something or spinning something off.
Yeah, and I agree with that. I think one of the hardest things to actually do, not so much as a seller but as a buyer, is how do you actually technically quantify in the cash flow exactly the things you're talking about, the brand, the IP. So purchase price allocators after the sale actually come in and they'll do large parts of that for you, right? They'll come in and they'll look at customer lists, and as you're building models, you're going to have to capture exactly those synergies, and I just call them synergies, that really accrue to a premium brand. IP, I've done some things in the tech space and the biotech space where we used real option valuation. It's a technique that is very complicated, still controversial, been around for 20 years, but a number of companies in pharmaceuticals, for example, or the energy space that I've worked with do use that. Very hard to get a board to really understand it, because the first thing they'll ask is the option, it's a real option, but is it tradable? Well, if it's not tradable, then it has no value, right? So it's a tough one. I think the human capital, the way I've dealt with it in the past, was really to go through a replacement cost analysis. We did a deal at TIA in 2014 for a fintech company. And the way we had to approach it was to say, so one of the valuation methods is how quickly could we build that team of 200 people that we bought, and what would be the replacement cost for it? And that set our boundary of what we were willing to pay for it. So there are ways to do it, but they're certainly not easy to be able to value these things, and they're a hot topic of conversation.
We've had, you raised a good point with the Siemens name. We've run into this on a couple of our divestitures where the Arm & Hammer brand, which is our billion-dollar, 150-year-old brand, was attached to it in some form, and OxyClean's another very popular brand that we have. And we've had different types of offers from a buyer who has said, if I don't get the license for that brand in perpetuity or for a period of time, then I have a lower value on the deal. And so we have to make a determination about the buyer and whether they're a good owner of that license, because it's very near and dear to us. The Arm & Hammer brand's been built up over 160 years. We're very careful with how we license it out. And in each case we ended up getting comfortable. It was a small family business that we felt comfortable with, and we got more value by including the brand name for a period of time. I think in each case it was 5 years or so.
And we've had the discussion both with buyers and sellers on the value of the assembled workforce. We were selling a business about a year and a half ago, and it was an engineering services business, and the buyer said, this is really attractive to me because we have, as a buyer, a market opportunity right now, and for me to put together a team like this, I could do it, but it would take probably 18 months to get the collection of expertise, the management structure in place, the systems, the working relationships. So the fact that this business that's not particularly distinguished in any way in terms of the expertise or the capabilities, but it's there, it's running, it exists, they can bid on things right now. So there's tremendous value in an assembled workforce. And we've had the discussion both as a buyer and a seller. We'll see something that's a startup, a growth stage business, and I'll say to our guys, isn't this replicable? Can't we make this on our own? And they'll say, yeah, but that's going to take us a year or 18 months to go out and recruit the talent and put the people together. This is a business that's up and running right now.
So to shift gears slightly, Brian, you brought up the topic of dealing with financial sponsors versus strategics,
Sure.
and Ken, you alluded to it as well. Roger, I'm sure you have some stories there. Not to cast aspersions on our friends in private equity, they have thick skin, so I think they can take it, but want to just understand some of the nuances, differences between dealing with those different communities of buyers, and whether it's, you mentioned the licensing agreements, and having those in place for those financial buyers is a critical component. What are the other components? Are there others that are top of mind as you consider your options?
I can tell you about on the private equity side, contrary maybe to conventional wisdom, as a representative of sellers, I actually did like the private equity buyers very much for a couple of reasons. One, the diligence is very different.
Yeah.
With a strategic buyer, and I've been on the strategic buying side and having been a strategic buyer, diligence is much more thorough and it could be much more laborious. The PE shops tend to have to work very quickly, in my experience, and they do a different level of diligence. The other piece is that a PE deal will be financially engineered. And as such, you can begin to predict where their actual levels will come out because you have a sense of how much equity they're going to put in. You know what they can raise money at based on what the actual credit rating of the entity is. You can predict where their pricing is going to be and where they're going to drop. Strategics, because they have the intangible synergies, could be all over the map. And in a low-cost environment for financing, like we've had over the last several years, it makes it doubly difficult to predict where a strategic, at least in my mind, is going to come out, because you really can't gain a full sense of how much they're willing to pay for long-term strategy or synergies.
Yeah, so to us, it's bifurcated on PE between, a PE firm who just wants to buy an asset from us, and it comes back to the whole ongoing relationship and being clean and getting out of a business quickly. So we'd prefer not to sell to just a private equity firm, a brand, or a group of brands, because they don't have infrastructure to run it. So we have sold to effectively a private equity firm in the past who had a small portfolio company that was able to add on these brands on top of it. Perfectly excellent experience and very happy with it. And absolutely right, Roger, about diligence is a little different. It could be a little more, it's more predictable in a lot of ways, and it's a little quicker. And so we were very happy to do that. It was when we sold the Orgel brands, we ended up selling it to a small OTC business that was owned entirely by private equity. Very excellent deal for both sides, and we were able to get out in 3 months and move on with our existing business. So big fans of private equity. It's just for us, we want to exit. If we decide we're going to exit a brand, we want out quickly and to minimize the operational complexity. And generally, strategics are a little quicker about that. So if there's some strategic component to it with private equity, that's a perfectly excellent scenario for us.
I mean, for us, it's a range of factors. We try to evaluate at the outset of a process whether something we're putting on the market is going to have appeal to private equity or strategics or both. And there's a number of factors we take into account. Whether a business really can be standalone. Does it have the infrastructure it needs? Does it have this sort of corporate services that a PE isn't likely to have on hand? Things like human resources, real estate, the back office stuff. So if we think something's going to have appeal to PE, we'll try to make it turnkey to bring PE buyers into the process. As far as the diligence is concerned, I think our perception is that by definition, PEs have third-party money involved, so there's going to be potentially a higher level of financial diligence in order to make sure that the asset can sustain the debt. So we try to prepare for that by just having more financial statement information ready and putting the buyer in a position to perhaps run different financial scenarios. With strategics, we know they're going to be all about trying to find synergies, so we try to prepare for more diligence in the areas of strategy, market development, operations, R&D, things where a strategic can really drive synergies.
Good, interesting. So we got actually an interesting question from the audience that I want to toss out to the group here, and it relates to the different sector dynamics. So you have some different backgrounds, obviously, and currently you're with different companies across a different spectrum of sectors and industries. Wanted to see if there was any recent flavor or trends or I guess more micro level things that you could discuss or relay to the audience. You know, Roger, maybe you could get us started.
Sure.
The financial crisis obviously had a significant impact.
It did.
Has that
did.
on a lot of things. But as it relates to carve-out spin-offs, what was your take as you're sitting there
Yeah, what was interesting
bracing yourself?
is you have seen a lot of divestitures, carve-outs, and spin-offs come out of the process. And I use that term generically, not technically now, coming out of the legislative changes out of 2008 with Dodd-Frank and the Volcker rule embedded in the Dodd-Frank piece. And it really came out across three basic sectors, I would say in three following trends. You saw a lot of balance sheet problems that had emerged with the new tests and what was required strategically. There were a lot of toxic assets on the books. And so what a lot of firms needed of all different types, they needed liquidity. And so divestitures of non-core assets, as we started the conversation, really became top of mind. And sometimes the regulators would force it. So what you saw in the insurance side, because of the regulations that were very onerous in some manners to insurance companies to become banking units, which have very different capital requirements and different rules, insurance companies by and large have been getting out of the business of banking. So you had 8 or 9 different companies that divested their banks in some way, shape, or form. Then you had other companies that had asset management businesses that had a lot of intangible value, but not the same kind of hard value on the capital structure. So those got sold off. And then you had in the situation of companies that were banks or investment banks and falling under the banking rules, they would get rid of very particular businesses, commodities platforms, proprietary trading platforms, private equities. These were due to the Volcker rule restrictions on banks. So what we've seen in the financial institutions business has been a large trend of these non-core divestitures going on since 2009, really. And while it's not as prevalent or large as it was in 2009, we're still seeing them happening, and a lot of financial institutions, both financial sponsors as well as strategics, take advantage of.
Brian or Ken, wasn't sure if you had any stories that you could relay related to your particular the industries that you live and play in every day.
We see technological change driving transactions to some degree, as well as regulatory changes. I mean, Siemens is in the healthcare business, and certainly regulatory changes in the healthcare industry have had an impact on profitability and business models and sales cycles and things like that. But also technological change and the emergence of economies in other parts of the world have driven some strategies. If you look at lighting, again, lighting is an industry that's undergoing quite a bit of technological change from our traditional incandescent bulbs to LEDs. LEDs are cheaper to manufacture, they last longer, they're cheaper to run, they save energy. But the change in tooling that's required of the traditional lighting makers is enormous. And the business is becoming very, very competitive from a manufacturing standpoint. So we spun off our Osram business a few years ago. We felt it would be a stronger competitor on its own. There was an announcement, I think, just within the last couple of days that Philips is considering or has already decided to do the same thing, make its lighting business independent of an otherwise global player in electronics and medical equipment. In some areas, Siemens and other Western manufacturers have manufactured feature-rich, highly technical equipment, whether it's healthcare or some other industry. Western economies, Western customers in developed countries have the money to pay for very expensive feature-rich equipment. They have technicians that can operate it. They have access to networks of spare parts and service providers that can keep this equipment running. But in emerging economies, what we used to call the BRICS, They don't have the money to spend on such feature-rich equipment. They don't have the availability of the highly trained technicians. They don't have the spare parts and service networks. So there's a need to produce products and equipment that have more of an appeal in those markets, and that can drive portfolio strategy as well. You want to put assets in the hands of people that can serve those markets better, or you want to buy assets yourself that will put you in a position to serve those markets better.
And Ken, actually, one thing that came to mind during a conversation we had the other day was around the hearing aid operation and your presence in that market, and how you're expressing frustration just in managing these small, disparate locations that just didn't quite fit in within the portfolio.
Yeah, I mean, that was a different business for Siemens. Historically, we have been very, very competitive in hearing aids. Our hearing aids are technologically among the best. There was a lot of brand recognition. Our hearing aids were considered higher end hearing aids, but it's primarily a consumer-oriented market, and most of our markets, if not all of them, are really industrial and institutional. We have large government customers and other institutional customers. Hearing aids are sold through very, very fragmented distribution channels, often in one-off transactions to a consumer, and it really just didn't fit with the rest of our portfolio. We have corporate compliance policies that call for collection in electronic payments whenever possible, and hearing aid customers come into a retail store and pay in cash. That was a tremendous challenge for our Treasury Department to have store managers walking over bags of cash to their bank at the end of the day to deposit the day's receipts. So, and also we were in a couple of hundred retail locations, which is very unusual for Siemens. So it just really didn't make sense in our portfolio. We sold it to a private equity buyer who will maintain it as one of the world's foremost hearing aid companies, very, very competitive with a handful of others that have the same global scale and recognition.
And Brian, we keep touching on brand when it comes to the sector dynamics. Is there anything else that you could layer on in terms of that topic, but anything else from a sector perspective that you can discuss?
Ken was talking my language, talking about consumer and retail. I don't think we get into hearing aids, but I was actually thinking, the only things electronic we make are battery-powered toothbrushes under the Spinbrush name, and vibrators actually under the Trojan name. So there's the only two things we have that are electronic in our whole portfolio. In fact, we're boring in general. You know, we sell laundry detergent, cat litter, you know, lots of it hopefully, and toothpaste, and pregnancy test kits and condoms and things that consumers use every day. What we find from a divestiture perspective and what happens with our peers is people stray from their strategy and end up moving into things that they think are complementary but end up being more complex than they think they are. And so you'll see people who are in consumer and food, and they're very different. And they think it's just selling to the same retailer. Well, it's a very different buyer. It's a very different consumer. It's a very different buying process at Walmart, for example. So we see a lot of it as people getting into certain categories and then getting out, quite frankly. Some people thinking pet's a really interesting category. Well, pet's very complicated versus a laundry detergent, for example. So it's a little different, and we enjoy boring. It works great for us, especially in downtimes. Our stock did great even in the worst of times because people still have to wash their clothes and brush their teeth, and people still have sex when times are bad. So our portfolio actually did quite well in a bad environment. As a matter of fact, people actually have more sex when they have time at home, quite frankly, as we learned.
Yeah, and so I think you're I think maybe downplaying your sense of or definition of boring.
It's definitely not boring. Well, some of it's boring, some is not.
Great. So we do have another question from the audience that I want to address, and it's what extent do the executives use external advisors, or how do you lean on them? Are you using them throughout the process? Are these something that you negotiate by yourself? I mean, you're seasoned deal makers, you know how to do this. Is it a time-saving thing? Do you use them? Why or why not?
Sure, I can give you one perspective that it depends on the transaction, but by and large there is a general rule. If the transaction is material, if the non-core asset that's being divested, or certainly if it's a spin-off, then the board almost wants to have that fairness opinion of anything that's material, right? It's really for public companies. TIAA-CREF is a private company, but it's the same. It provides a perspective that is not necessarily the same group that is actually working on valuing and structuring the company. You may have two different advisors to have a check. So in my experience generally, when you are considering a spin-off or you're even trying to do something smaller but yet still material enough to report, you can have a great team inside, great corporate development teams like ourselves, but having somebody else come in as well, acting as both a check, process facilitator, means of gathering intelligence for you, as well as just an organizer, makes a lot of sense from a process perspective. And on the board side, it's a great assurance factor that the way things were done in accordance with custom and law, et cetera.
I tell you, we look at it from similar, but in three different perspectives. So when we're selling a business, we're carving something out, we always will use an advisor, mainly because we know how hard it is. It's very hard. It's much harder to sell something than to buy something, quite honestly. And I harp on this with our team all the time, especially internally, that I always say, remember all those questions we ask and what a pain we can be? Well, it's coming right back at you, and then maybe more so. So let's be prepared. And for us, I don't know about you guys, but we're pretty lean. Even though we're an $11, $12 billion company, we still say pretty lean and mean. I'm the only person who does strategy and M&A or do anything related to it at our company. So there is a time issue. But we will use a third party. It's much easier. They know all the buyers probably better than even we do, especially if it's a small, quirky business. On the buy side, we'll bifurcate it between material deals that are above a certain threshold in terms of using an advisor. Use an example, last year we bought two small family businesses, and in each case, it was borderline mandated by each that we not use an advisor and that we do it kind of privately and quietly once we've negotiated sort of a deal. So in that case, we do it ourselves, myself and our team. And it's been fine. For a smaller deal, it's not as, again, it's a little easier to buy something than it is to actually sell something, surprisingly.
So Ken, are you able to look at yourself in the mirror and realize that you can be a pain when you're on the other side of the table?
That means I'm doing my job right, I guess, in some instances. But I agree with Brian. There are atmospherics in some deals that tell you either you should use an advisor or you shouldn't use an advisor. And when you're buying a small entrepreneurial business that maybe is family-owned or still in the hands of the founding family, bringing in a Wall Street advisor can sometimes change the dynamics, and whereas that usually helps to get things done in certain instances, it can change the atmospherics and present its own challenge. But like Roger mentioned, we also will, in a major divestiture, use an outside financial advisor for a fairness opinion. And I think traditionally you think of fairness opinions as something a public company board gets when selling the company. But I think more and more boards of directors are using fairness opinions to serve as an independent check when even making a material divestiture. And you mentioned your company is privately held, but you still have shareholders and you still have board members that are accountable. So whether you're in a public company or a private company scenario, I think board members want the additional security of having something looked at by a set of outside experts. Obviously, when it comes to other consultants, sometimes we'll use accounting firms. We have a lot of internal resources. Maybe this is one area where our experience contrasts a little bit with Brian's situation, but
Already jealous.
We have, I would say, very, very strong, robust internal resources, particularly in the accounting area. We have a dedicated team of audit experts that can go in and produce financial due diligence. I'd say that's competitive with what anyone out there is doing. That's not to say we never use, the standard names that you'll see, but we rely on them very heavily. We have very robust M&A resources, and we're able to do a lot of transactions on our own without the use of financial advisors, but we will use them. If the other side has a financial advisor, sometimes it's very, very helpful. You have an additional channel of communication. You have people speaking the same language. You have people using the same vocabulary to critique each other's model and talk about what comparables or precedents really should shape valuation and negotiations on a transaction. And obviously we'll use outside lawyers. I wouldn't say there's a specific deal size or threshold that above which we always use advisors, below which we never use. It really can vary from deal to deal depending on what we're trying to get done and the nature of the asset.
What I'd like to do is just transition the conversation a bit and go back to something that Roger brought up earlier, and that's related to the implications of antitrust and how those factor into our decisions, actually from a couple different angles. So from a potential seller, does that limit our universe, or are we forced to actually consider these options due to something that we purchased and we own, too much of a stake in a particular market? And also, conversely, what opportunities arise when potentially a competitor is in the same situation? How do you keep tabs and monitor assets that might come up for sale due to others being in that similar position? So I wasn't sure if anyone wanted to kick off this piece.
When you're a mandated seller, you have to sell something to get antitrust clearance. That's a rough spot. Sometimes the regulatory authorities will even define the buyer universe for you, and they will define it so narrowly that there's really only one buyer, and then that buyer will know they have quite an opportunity. And as a seller, you can have an asset that has value on your hands, but it's extremely difficult as a seller in that situation to drive a transaction that creates value. You're really just trying to protect value in those situations and protect the value of the bigger acquisition that you're doing.
Yeah, I tell you, it's funny you said that about the seller, because we've taken advantage of that actually, where one of our better deals we've done is due to a forced divestiture. We bought Spinbrush from Procter & Gamble when they were buying Gillette, and they were making a $50 billion deal, and what was holding it up was a little small, battery-powered toothbrush brand. And we definitely took advantage of it and got a very strong terms because we were one of the few trade buyers, and that's where they wanted it to go. Mm-hmm. And we were also friendly. There was some competitive. They didn't want to sell it to a deep competitor, so we were a logical solution. So we've taken advantage from that perspective. But even from a buying, we look at that a lot, where relative shares and whether you're going to have an issue. We've run into negotiations where the question is who takes the risk and what's the downside if things don't go through. And it's come up in a few items. I can't get into them in detail, but it certainly has become an issue for us and others. And so we love to take advantage of it, but it gets complicated. And we're in a world where share matters, and having over a certain threshold becomes a problem.
Yeah, from my perspective, I've been lucky in that I've never actually been caught in a divestiture situation because of antitrust. So I haven't had actually that direct experience, but I have thought about things as a buyer, and it makes for really complicated game theory calculations because you go into a deal, whether it's a public auction or even a negotiated sale, and you try to set a certain price and certain terms, but underpinning that is a question of whether or not the regulators, and it may not be the US, right? It may be something abroad, will for some reason cause you to divest something. And you have to price that in. But if you're in a competitive auction, and it's uncertain because you've not gone through the full process, no matter how much you pay our friends who are attorneys on the outside, you really don't know how to exactly establish a proper price. And then when you start getting into more convoluted scenarios whereby you go in with one or two buyers, and I've actually done that. I've structured back-to-back transactions and having tripartite transactions, and it gets very complicated. And the odds of winning something like that really diminish, as you can imagine. So people do encounter that as buyers. It's fantastic when you can take advantage of it, absolutely. But even as a buyer, thinking about what antitrust might mean in any jurisdiction really complicates the process, and it's not a great one to be in.
Yeah, and that can come with baggage too. I mean, the whole point of a mandated antitrust divestiture is for there to be a viable competitor that's going to continue in the market for a number of years and keep pricing where it needs to be and protect the interests of consumers. So as a buyer, you have to think about integration, strategy, whether you need to sustain certain product lines or markets that you otherwise wouldn't necessarily think to do if you were just making a strategic acquisition on your own. So it can come with some restrictions too.
It reminds me of when we were talking about spin-offs towards the beginning. When you're trying to achieve a real spin-off, a tax-free spin-off, there are rules that prevent you, for example, from taking an asset that, let's say, you're not trying to unlock value of the subsidiary, you're trying to relieve value from the parent, but you have a lot of rules in terms of setting out a business that is viable, right? And so you have to be very careful how you structure that spin-off, how much debt you can put on the spin-off, and sometimes it really limits your options as how do you actually get rid of a non-core asset.
I guess on that topic, and just to follow on, are there any creative structural terms that you've employed to facilitate these types of deals? Obviously, a bag of cash is always preferable. It's not always feasible. Wasn't sure, Brian or Ken, if there's anything that you've employed.
Without getting into specifics, we just want to make sure that if we sell something, it's going to be viable in the hands of the buyer, whether it's a strategic buyer or a private equity buyer, or whether it's the market. So we put divested assets or assets that are being divested through some solvency tests of our own, and we try to just make sure that the asset, if it's going to be spun off, that it's going to be able to attract capital on its own, and that it will generate earnings and cash flow. If we have a choice of buyers, if we're in the fortunate position where there's a competitive auction, the nature of the buyer, the stability, liquidity, solvency, and the how realistic the buyer's business plan is may play a role. We might not accept the highest number necessarily that comes out of the auction. We'll take into account other factors like whether we think there's really opportunity for growth and for innovation, whether customers will be best served, whether the workforce will be best served in the hands of one buyer versus another. So we'll look at all those factors in deciding whether to divest, and sometimes we may decide not to if we can't be satisfied according to all the criteria.
Yeah, we've never, we haven't sold anything that's had antitrust issues, but I can actually say from the buy side, we were able to extract very long-term license of a name, as well as a very long-term non-compete that, you know, it's always nice when it's government enforced effectively versus even just from a legal perspective, which there's some issues in terms of how long you can have a real non-compete for. So there is advantages from a buyer side, and if we were selling, you'd have to go through the same scenario. And so it's again, it's good to buy, tough to sell, and not fun. And the regulators, and you're dealing with the government, and they're not predictable, and they go on they have a different end goal and a different constituency, and they make decisions that are not as predictable as you would like as a corporate, where you like things where you know what the outcome's going to be. It's uncomfortable.
I think that, you know, and probably this is for a different session altogether in terms of structural mechanics. I've seen for divestitures, not for spin-offs, but for divestitures in particular, all sorts of structures like earn-out structures and holdback structures and clawback structures. Yep. But I think some of the more interesting ones that really are not conventional in terms of the consideration aspect or how you time the consideration are things like what both of you mentioned, brand licensing agreements, but also, and I'll put it broadly in the category of transition service agreements, which could include, if you are selling something but you own the facility, structuring a lease arrangement. In other words, other economic streams that you can generate from the divestiture if you're a seller that really go to perhaps supporting with IT or perhaps supporting with some type of brand licensing or giving support from the parent to the business for a period of time. And that sometimes is enough to be able to change the economics of the deal. So those are other things that I've seen in the market.
I mean, with Siemens, frequently there's either a supply arrangement or a customer arrangement with almost anything we sell. And often the terms of that supply agreement or that purchasing agreement become part of the value equation in the transaction. We go through negotiations internally that are sometimes more difficult than negotiations externally with respect to who's going to subsidize the business that we're selling. If we are indeed going to subsidize it, do we have an internal customer that's willing to pay top dollar for products from the divested business unit or for services for a guaranteed period of time? Likewise, are we willing to supply on most favored nations terms for a period of time in order to ensure viability? So those commercial relationships will certainly enter into a negotiation.
So we've got a few minutes left here, and maybe Roger, you could get us kicked off on one of our final topics, and that's really it's broad, but I think we can touch upon a few kind of high-level things here in defining what makes a success and thinking about the characteristics that help make these transactions go as smoothly as possible, both when you are on both sides of the table. So when you're looking to divest something that's no longer core or spin something off, or potentially be the person on the other side who's taking that asset in. And was curious if Roger, you could just share a few perspectives at a very high level around how you think about it and maybe some key lessons learned.
Sure, I can take the angle I started with at the beginning, which was the valuation angle. So, and this is the easy answer, right? The easy answer is if you're undertaking a divestiture or a carve out or a spin-off, and the spin-off is the easiest one to measure, I think, in some ways because it's tracked. And if you've created value, both for the parent and for the subsidiary, which are the same shareholders, then you won, right? The case that I think we had talked about on another occasion, which was the sale of Red Lobster, right? You saw after the sale by Darden Restaurants, you had an increase of something like 30% in the stock price of the core company, right? So that could be seen as a success. But then adding to that, what happened because of that, you lost the CEO and the board that was arguing very much for that, right? So that was not a personal success, but for the shareholders, value was created. So I would see that as a really easy lens by which you can achieve it. And I think there are other lenses strategically that we could also consider.
Ken?
I mean, I would agree. Ideally, the value should ultimately be reflected in stock price, which is a reflection of shareholder sentiment. Management needs to be able to tell the story of why you divested something or why you acquired something. And we certainly pay a lot of attention to putting management in a position to tell the story in a relatable way to shareholders and analysts. But ultimately, you want to build shareholder value according to your criteria. We try to be consistent with applying our financial criteria, things like return on invested capital, EVA accretion, other financial metrics. And those ultimately should translate into shareholder value.
And are those the metrics that similarly tend to define success for you, Brian?
So on the buy side, yes, it's certainly financial. So there's three parts. One, financial, obviously, it needs to be a strong deal, both buying and selling, that it did what you said it was going to do. It's very important for us, obviously. We're very metric driven. On the sell side is actually achieving the operational simplicity is important, that we are able to actually divest and actually simplify our internal businesses, and that the other side is happy with what they got, which leads me to the third one, which is reputational and being seen and actually executing on being a good partner both on the buying and the selling side. It's a small world, especially in our industry, And if you're perceived as being difficult to work with, difficult to deal with after a deal, it changes your perception. And we are very active in buying and selling in the industry, and we want to make sure that people who've bought stuff from us are happy with it years from now. I check in with people years later to make sure that we didn't do anything that was difficult for them, and it's also a learning experience. And then buying is making sure that we weren't that we were a good buyer and that we weren't being unreasonable in certain areas. So it all comes back to comes back around eventually in reputation.
Excellent. So I think that brings us to about the end of our hour here today. So this has been a very lively discussion. Very much enjoyed the participation, the insights. I want to thank you for being here today, and also thank all of you for attending and watching. Thank you.